CPF is the most important financial account for every Singaporean, and often the one that we understand the least. Many of us view it as a simple black box. Contributions go in automatically each month and eventually in retirement. It provides monthly payout through CPF Life. That's the basic picture for most. But treating it purely as a set and forget system can mean missing out on significant long-term growth. Over a working lifetime, the difference from optimizing it properly can amount to hundreds of thousands of dollars, thanks to compounding and the higher interest rates available. In this video, we will open up that black box, how the different accounts, ordinary, special, MediSave, retirement, actually function, the interest rates that many overlook, including the government-backed extra, and practical steps to use CPF more effectively to build lasting wealth. This is designed to be the comprehensive CPF guide you will need. CPF has three primary accounts: ordinary, special, and MediSave, each with a distinct purpose and interest rate to guide how your savings are used. Your ordinary account, OA, earns 2.5% per annum. This is the most flexible account. You can use funds from it to purchase an HDB flat, service home loans, pay for approved education expenses, invest in certain instruments through CPF Investment Scheme, or eventually support retirement needs. Your special account, SA, earns 4% per annum and is dedicated to retirement savings. Withdrawals are restricted. No access for housing or other short-term users. The higher interest rate serves as an incentive to keep these funds untouched for the longer term. Your MediSave account, MA, also earns 4% per annum and is strictly for healthcare needs, hospitalization costs, approved medical insurance premium like MediSave Life, and other eligible medical expenses. At age 55, savings from your SA and potentially part of your OA flow into the retirement account, RA, which likewise earns 4% and forms the basis for money payout in retirement, often via CPF Life. As your income rises, your CPF contributions increases accordingly, up to the applicable salary ceiling. For employees below 55, the standard rate is 20% from you and 17% from your employer, totaling 37% of your wages. This represents substantial forced saving that compound over time in your favor every month. One of the most overlooked features of CPF is the additional interest paid by the government on top of the base rates. For members below 55, you earn an extra 1% per annum on the first 60,000 of your combined CPF balance across all accounts, with a cap of 20,000 from the ordinary account. This means the first 20,000 in your OA effectively earns 3.5%, 2.5% base plus 1% extra. The next 40,000, typically in SA or MediSave, earns 5%, 4% base plus 1% extra. For members aged 55 and above, the extra interest is even more generous, 2% per annum on the first 30,000 of combined balances, capped at 20% from OA and 1% on the next 30,000. This can push effective rates up to 6% on the initial portion, 4% base plus 2% extra, and 5% on the following tier. This extra are applied automatically, no action required, and compound over time. Over a full working career, especially with transfers to higher rate accounts, this can add tens of thousands of dollars to your retirement savings. Surprisingly, many Singaporeans are unaware of these tiers or how they apply, yet they represent one of the most reliable ways the system rewards long-term saving. Using your CPF Ordinary Account, OA, to finance your HDB flat or any property is often one of the largest financial commitments you will make in Singapore. It can feel straightforward since no cash changes hands upfront, But there is an important detail that catches many people off guard. When you sell the property, you are required to refund the CPF amount withdrawn, plus the accrued interest. This accrued interest represents what those funds would have earned if they remain in your OA. Currently calculated at 2.5% per annum, compounded monthly from the date of withdrawal. For example, if you have used a substantial portion of CPF, say the equivalent of 400,000 over 20 years, the total refund amount, principal plus accrued interest, could significantly higher than the original sum withdrawn. Over a long holding period, this compounding effect adds up noticeably. This rule exists to safeguard your retirement savings by ensuring CPF funds used for housing are restored with equivalent growth. It doesn't mean you should avoid using CPF for property altogether. Many benefited from it. But it does mean you should factor in the full refund obligation when planning. Before assuming the net proceeds from a sale are all profit, always check your estimated CPF refund amount, including accrued interest, through your CPF account dashboard or CPF tool. Understanding this upfront helps you make informed decisions about housing, upgrades, or long-term wealth planning. The CPF Investment Scheme allows you to invest savings from your ordinary account and special account in a range of approved products, including unit trusts, ETF, Singapore listed shares, government securities, gold, and more. In principle, this offers the potential for higher returns than the guaranteed CPF interest rates. However, the practical experience for many participants has been different. Historical data and CPF board reports indicate that a significant portion of CPFIS investors, particularly those in higher fee or actively managed products, have underperformed the default rates they forgo. For instance, older analysis shows that more than half would have been better off leaving funds in the OA at 2.5%. The key threshold is clear. To make CPFIS worthwhile, your investments must consistently outperform the foregone CPF rate of 2.5% for OA or 4% for SA, after accounting for all fees, charges, and any transaction costs. Market volatility, emotional decision, and higher expenses can make this difficult to achieve reliably. That said, lower cost passive options like index tracking ETF, such as the SPDR STI ETF for local market exposure, or globally diversified ones, have historically delivered returns that clear these hurdles over extended periods, often through broad market compounding. If you choose to invest via CPFIS, prioritize low-cost structures, maintain a long-term perspective, spending decades rather than months or years, and ensure it aligns with your overall risk tolerance and retirement goals. For many, the guaranteed returns rates remain a strong risk-free foundation, especially when combined with the extra interest tier discussed earlier. CPF Life is the national annuity scheme that converts your CPF retirement account savings into guaranteed monthly payout starting from age 65 for as long as you live. There are 3 plans to choose from. The standard plan provides a fixed monthly payout that remains level throughout retirement. The escalating plan starts with lower initial payout but increases them by 2% annually, helping to offset rising costs over time. The basic plan offers higher payout in the early years, which then decrease progressively as your combined CPF balance falls below certain threshold, providing less protection against very long lifespan compared to the other plans. The benchmark to understand is your cohort full retirement sum, the amount set aside in your RA at age 55 that qualifies for this long-term payout. For members turning 55 in 2025, the FRS is 213,000. For 2026, it is 22,400. These figures increase gradually each year to reflect inflation and living standards, and your personal FRS is fixed based on when you turn 55. If you meet the FRS in your RA by age 55, you can expect estimated monthly payout from age 65 of roughly 1,590 to 1,710 under the standard plan for 2025 cohorts, or 1,640 to 1,750 for 2026 cohort. These are indicative figures for a new member. Actual amounts depends on your exact savings, plan choice, and other factors. You can increase your future payout by making voluntary top-ups to your RA using cash or transfer from your OA up to the enhanced retirement sum, currently at 440,800 in 2026, which can significantly boost monthly income potentially to 3,000 plus under standard. CPF Life stands out as one of the most reliable, low-risk tools for retirement income in Singapore. Yet many don't fully optimize it through top-ups or careful plan selection. Reviewing your options around age 55 or even earlier via voluntary contribution can make a meaningful difference to your long-term financial security. Here's a straightforward action plan to start putting what we have covered into practice. First, log into your CPF account at cpf.gov.sg. Check your current balance across the ordinary, special, MediSave, and retirement account, if applicable, along with the interest rates and any extra interest you are earning. This gives you a clear snapshot of where you stand. Second, use one of the CPF board online calculator, such as the Retirement Projection Tool or Monthly Payout Estimator. Input your details to project how your balance could grow over the next 10 or 20 years at the current guaranteed rates, assuming no changes. Most people find the compounding effect surprisingly substantial, even without additional contributions. Third, if you have spare cash and are aged 55 or above, consider making a voluntary cash top-up to your SA or retirement account. These funds earn 4% per annum, plus the government extra that can push effective rate higher on the initial portion, which is competitive and low risk compared to other options. Cash top-ups are also qualified for personal income tax relief of up to 8,000 per year for contribution to your own account and potentially another 8,000 if you top up for eligible family members, helping reduce your taxable income while building retirement security. This applies to cash top-up transfers from your OA do not qualify for tax relief. I will include direct links to the CPF login portal, projection calculator, top-up application page, and tax relief details in the video description below for easy access. Taking this small step can help you make the most of CPF built-in advantages over time. That covers CPF in full, from the accounts and interest structure to optimization strategies like transfer, top-up, and CPF Life. Next week, we will shift to other key savings instruments, the current best yield savings account from major banks, Singapore saving bonds, and treasury bills. I will compare their yields, liquidity, risk, and suitability, especially for building or parking your emergency funds, so you can decide where your cash works hardest right now. If you found this CPF guide useful and clearer than before, please subscribe to Wallet Hustle so you don't miss the next one. And if you could help a friend, family member, or colleague better understand their CPF, feel free to share the video. Thanks for watching. See you next week.